Welcome to the debate. Today, we are looking at a number, $800 trillion.
That is quite the starting point.
It is. 800 trillion. It is not just a statistic in a spreadsheet. It is the estimated weight of the entire global fiat system. Stocks, bonds, real estate, sovereign debt. It is a structure so massive, so all-encompassing that we just assume it is permanent. We treat it like gravity. We assume the sun will rise, and we assume the S&P 500 will compound at 8%. But what happens when the foundation of that structure begins to liquefy?
And you are arguing that foundation is software.
Exactly. For the last 30 years, global growth has been built almost entirely on the value of proprietary code. And we are not looking at a market correction here. We are not looking at a recession. We are witnessing the early tremors of a deleveraging event of historic proportions. The fiat system is an $800 trillion Titanic. And right now, the only lifeboat that cannot be copied, cannot be hacked, and cannot be diluted is a $2 trillion asset called Bitcoin.
Well, that is a terrifying picture you are painting. It has the distinct feel of a geopolitical thriller, but it relies on a premise that is frankly apocalyptic. You're suggesting that the entire value architecture of the modern world, the credit markets, the banking system, the pension funds holding the savings of millions, is about to be zeroed out because of a technological shift in artificial intelligence?
It is a profound shift.
It is a transformation, certainly. I see the same data points you do, but I do not see a Titanic. The idea that $800 trillion is going to try to squeeze through a $2 trillion door, that isn't just a rotation. That is a total collapse of civilization. And I am simply not convinced the global economy is quite that fragile.
That is exactly what we are dissecting today. The Great Rotation. The central thesis we are debating is whether artificial intelligence is creating a deflationary force so powerful that it will destroy the profit margins of the software industry, collapse the credit markets, and force capital into true scarcity. When intelligence becomes free, does the stock market die?
Right. And I am here to challenge the inevitability of that collapse. I want to examine if this death of code is a reality, or if it is just a dystopian fantasy being used to justify a specific financial position.
Let's begin with the mechanics of this rotation then. We need to set the scene. For the last decade, really since 2008, the investment thesis was incredibly simple. The government prints money, liquidity enters the system, and risk-on assets like tech stocks and Bitcoin go up together. That correlation has been the law.
It has been the heartbeat of the market, yes.
But if you look closely at the charts, specifically since late 2023, that correlation is breaking. We are entering a new regime, one where deflation equals deleveraging.
Hold on, let's define terms here, because this is where the narrative usually gets a bit murky. Deleveraging is just a technical term for reducing debt. Why does AI, which is essentially a productivity tool, cause global debt to implode?
Growth. Specifically, growth in tech and software. But here is the catalyst. Exponential innovation. Artificial intelligence is driving the marginal cost of intelligence to absolute zero. Think about what that actually means. When intelligence is free, the ability to write code is free. When code is free, the moats, the competitive advantages that protect companies like Salesforce, Adobe, or the thousands of junior SaaS players evaporate. We are staring at a future where software is a commodity, like wheat or corn. It is no longer a high-margin business model.
And without margins,
the company has no value. If the company has no value, the debt they issued becomes worthless. That is the deleveraging. And in a world of infinite digital abundance, capital has only one place to hide: scarcity.
I see the logic, I really do, and it has a certain elegance to it, very clean. But let me push back on the financial conclusion here. For years, the Bitcoin thesis was money printing equals number go up. Inflation was the driver. Now that we are seeing liquidity dry up and deflationary pressures mount from AI, the narrative seems to be rapidly shifting. Now it's deflation equals number go up.
I hear that critique a lot.
It feels like moving the goalposts. Ensuring the conclusion remains exactly the same regardless of the macroeconomic weather. Are we just retrofitting a theory to support a bag-holding bias?
It is a fair critique on the surface. It does look like a pivot. But this isn't about changing the narrative. It is about the evolution of value itself. Look at the players on the board. The wealthy, the demographic that holds the vast majority of that 800 trillion, they do not believe in Bitcoin yet. They hold stocks, they hold bonds, long-duration assets. They are betting on the next 10 years looking exactly like the last 10.
Because historically, that has been a safe bet.
But if I tell you that 10 years from now, a humanoid robot and a swarm of AI agents can replicate the entire business model of a Fortune 500 company for pennies, how do you value that company today? You can't. That is why the rotation is inevitable. It is not a choice. It is a forced migration from abundant assets, code, to scarce ones, mathematical finality.
But that assumes those legacy companies just stand still. You are predicting the extinction of the S&P 500 based on the idea that they won't use this technology themselves. I argue that the global system is far more resilient than you think. Microsoft isn't just going to watch itself die. It is going to buy the AI. It is going to integrate it. But let's dig into the specific mechanism you mentioned, the death of software companies. You called it multiple compression.
Yes, multiple compression is the canary in the coal mine. For those listening, a multiple is essentially how much investors are willing to pay today for a dollar of a company's future earnings. Right now, we are seeing software companies posting record earnings. On paper, they look incredibly healthy, but their stock prices are falling. Why? Because the market is forward-looking. The market is starting to realize that 3 years from now, those earnings might not exist. It is the hotel newspaper phenomenon.
The hotel newspaper?
Visualize it. You walk into a luxury hotel breakfast room. Who is reading the physical newspaper?
The older demographic, usually.
Exactly. It is the past. The news is there, the paper is crisp, but the medium is dead. The digital world has already moved on, but the physical habit remains for a select few. Public companies are becoming the physical newspapers of the economy. They are bloated entities. Look at the S&P 500. These companies are like 60-year-old men who are 100 pounds overweight. Now compare them to the new AI models. Agile, young, rapidly evolving. The market is compressing the multiples on these software stocks because it knows they cannot compete with the deflationary force of AI. Look at the IT services sector, down 20%. The rot has already started.
Look, I just do not buy that the entire sector is, quote, rot. I will grant you that IT services are taking a hit because companies need fewer human consultants when they have AI. That is efficiency, that is not death. But to leap from there to the total death of software is a massive stretch. Even if code becomes abundant, even if everyone can build an app, you still have a discovery problem.
How so?
If there are a billion bespoke apps created by AI, how do I find the one I need?
You ask the AI to find it, or more likely, you ask the AI to build it for you on the spot. Build me a CRM that tracks my clients. Done. 5 seconds. Why do I need to pay Salesforce?
But you do that through an aggregator. You do that through Apple or through Google, through the App Store. The value doesn't just disappear into the ether. It shifts to the gatekeepers. The moats aren't vanishing. They are just moving to the companies that control the distribution infrastructure. The value of intelligence might actually make these platforms more valuable, not less. They become the curators of the chaos. So why would the stock market collapse if the biggest companies just get stronger?
You are betting on the landlord surviving when the tenants are all dying. It is a very risky bet. But even if you are right about the aggregators, there is a darker element to this rotation that makes the gatekeeper argument entirely irrelevant. It is not just about economics anymore. It is about security. We need to talk about agent swarms.
Agent swarms. This sounds like we are moving straight into science fiction.
It is science fact. We are seeing the deployment of tools right now, OpenClaw. We aren't talking about a single hacker in a hoodie drinking energy drinks anymore. That image is quaint. We are talking about billions of AI agents. Let's call them billions of Einsteins, running 24/7 with an IQ of 140, specifically tasked with finding vulnerabilities in corporate networks.
A digital army.
Exactly. A swarm. Think about the target here. Traditional enterprises. Banks, logistics companies, retailers. They are running on legacy infrastructure. They are running mainframes from the 1970s wrapped in a sleek digital interface. They rely on COBOL code that no one even knows how to patch anymore. When a swarm of AI agents attacks that infrastructure, searching for a single vulnerability in the API or the ledger, it isn't a fair fight.
The attack surface is too large.
Yes. The security risk for traditional equities is becoming unpriceable. If you cannot secure your ledger, you do not have a company. And this brings us right back to the rotation. Where is the only place you can store value that is mathematically secure against a swarm of Einsteins?
You're going to say on-chain.
It has to be on-chain. It has to be Bitcoin. The encryption architecture of Bitcoin SHA-256 is the only thing robust enough to survive this environment. The safety trade isn't just about monetary policy anymore. It is about cybersecurity. Capital will flee the vulnerable off-chain world of bank ledgers, which are essentially just Excel spreadsheets that can be edited, and move to the on-chain world of cryptographic finality.
That is a compelling narrative. Really, it is a cyber thriller. I can see the movie poster right now. But have you considered that this is an arms race? You are framing AI entirely as the attacker. But these same legacy companies, Microsoft, Google, the major banks, they will have their own billions of Einsteins focused entirely on defense. They will use AI to patch holes faster than the attackers can find them. Why do you assume the offense automatically wins?
Because of asymmetry. Defense is always mathematically harder than offense in a digital environment.
True, but
The attacker only needs to find one hole, one open window, one lazy password. The defender needs to plug every single one forever, every millisecond of every day. The odds are strictly with the swarm.
perhaps. But let's follow that logic. If billions of Einsteins can hack a heavily fortified bank, are you so certain they cannot find a vulnerability in the peripheral infrastructure of crypto? Not the blockchain itself, I grant you that, but the wallets, the exchanges, the cross-chain bridges. If the world is as unsafe as you say it is, then digital bearer assets might be terrifying to the average person.
They will have to adapt.
But think about the psychology. If I lose my password or get hacked, my life savings are gone. Zero recourse. If my bank gets hacked, the FDIC steps in. The unsafe world narrative might actually drive people back to centralized institutions, not away from them, simply because they want a third party to hold the liability.
The FDIC cannot bail out a system when the asset base itself has been devalued to zero. You are trusting institutions that are structurally obsolete, and this obsolescence is happening faster than anyone realizes. I want to paint a picture of where this goes. I believe that in 10 years, we might not have public companies at all.
No public companies? That is an incredibly bold claim. You're saying the entire concept of the corporation, the engine of capitalism for 400 years, just disappears?
The capital structure is changing. We are moving from electronic CSIPs, which are just digital entries of paper stocks, to native digital assets. But more importantly, the economy is fragmenting. Look at the signals. We are seeing stay-at-home moms using AI to build full bespoke educational curriculums, bypassing the standardized school system entirely. We are seeing salespeople with absolutely zero coding knowledge building functional business apps in 4 hours using tools like Replit or Lovable.
I have seen the demos. They are impressive, I will give you that.
They are more than impressive. They are destructive to the old order. If a salesperson can build a bespoke app to solve a business problem in a single afternoon, why does his company need to pay millions of dollars for an enterprise software license? We are moving toward an economy of little entrepreneurs and bespoke solutions. The era of the bloated, standardized public company is ending. And if the companies end, the stocks end. And if the stocks end, that $800 trillion has to go somewhere else.
I strongly challenge the scalability of that vision. A bespoke economy sounds deeply romantic, a world of digital artisans and creators. But a stay-at-home mom creating a curriculum does not replace the logistical infrastructure of the global economy.
It is the start of the unraveling.
But who builds the ships? Who manages the global energy grid? Who builds the massive data centers required to run these AI models in the first place? You cannot code a power plant into existence. You cannot prompt engineer a container ship.
The hyperscalers.
Exactly. Microsoft, Google, Amazon, they aren't going away. They are becoming the utilities of this new world. They are the landlords. You can have your bespoke apps, but you are renting the computing power from them. So the idea that public companies die seems to completely ignore the massive industrial reality required to run artificial intelligence. These companies will change, certainly, but they won't disappear.
They might survive as utilities, sure, but utilities do not trade at 50 times earnings. They trade at 10. That is still a massive crash in global value. But even the hyperscalers are vulnerable to the final point of this rotation, the credit crack.
The credit markets.
Yes, the hyperscalers are issuing debt like never before to build these data centers. Google just issued $30 billion in debt. And who is buying this debt? Who is holding the paper?
Pension funds, institutional investors, the usual suspects.
And this is the trigger event. This is the moment the fuse is lit. Look at the private credit market. It is heavily exposed to software and SaaS companies. Investors have poured billions into private credit deals for tech, assuming those steady recurring revenues would last forever. But if I am right, if AI deflation destroys those revenues, if the seat-based pricing model dies because AI agents don't pay for seats, then the collateral for all that debt evaporates overnight.
You are pointing to a subprime moment for the tech sector?
Precisely. Look at the headlines. Blue Owl. Look at the rising delinquencies in auto loans and student loans. They are back to 2008 levels. The consumer is cracking, and the software companies that rely on that consumer are next. If private credit valuations collapse because the underlying software is worthless, you get a margin call on the global economy. That is the moment the rotation becomes a flood. The money cannot stay in stocks. They are too vulnerable. It cannot stay in bonds because the government will have to print to save the system, causing massive inflation. It has to go to scarcity, gold, and Bitcoin.
You are weaving together a perfect storm. Software failing, credit failing, and AI hacking everything simultaneously. It is a highly coherent theory, I will give you that. But I look at the high-yield spreads right now. The difference between safe bonds and risky bonds. They haven't blown out yet. The market isn't panicking. The hyperscalers have massive cash flows. They are sitting on absolute war chests.
The market is always calm before the deleveraging. In 2007, the market was hitting all-time highs while the subprime rot was already destroying the foundation.
Aris, the market is rational. Perhaps the rotation isn't a flood, but a trickle. You talk about native digital assets. I agree that tokenization is coming, but maybe instead of destroying the old system, it saves it. Maybe we see real-world assets, RWAs, being tokenized, stocks becoming tokens, real estate becoming tokens. This would be a bridge, allowing the 800 trillion to slowly migrate onto the blockchain without burning the world down. Why does it have to be binary? Why can't the old world migrate to the new rails?
A bridge implies you can go back. I do not think we can. The shift to digital scarcity is a one-way street. And frankly, tokenizing a stock that is fundamentally losing its business model to AI doesn't save the stock. It just makes it easier to sell. It makes the panic faster.
That is a fair point. Speed definitely kills in a market crash. But let's look at the time horizon. You mentioned the wealthy boomers earlier. They hold the keys to that capital. They are inherently conservative. They move slowly. For them to dump their entire worldview and buy into a digital lifeboat requires a level of sheer panic that we simply haven't reached yet. They trust the Fed. They trust the traditional banks.
The fear arrives when the value disappears. I want to go back to the image of the hotel newspaper. It is tragic, in a way. You see these massive institutions, these powerful people clinging to a format that is already dead. They just do not know it yet. The wealthy are currently holding assets that are effectively short volatility and long code. They are betting that the future looks exactly like the past. I am arguing that the future looks like nothing we have ever seen. When you have an asset like Bitcoin that is decoupling from the NASDAQ, that is acting as a sponge for liquidity while tech stocks bleed, that is the signal. The correlation is broken.
And that is where I will concede a critical point to you. If Bitcoin truly separates itself, if we see a month where the Nasdaq crashes 10% and Bitcoin rallies 10%, then the psychological dam breaks. That would be the definitive proof of your rotation. But until that decoupling is completely undeniable, I remain deeply skeptical that the world is ready to deleverage $800 trillion into a $2 trillion bucket. That mathematical squeeze would be violently destructive.
It will be violent. But look at the early signs. The IT services crash, the credit delinquencies, the rise of the sovereign individual using AI to outcompete massive corporations. It is happening on the margins right now. And then it will happen all at once.
Complexity usually requires multiple perspectives. You see a catastrophic collapse. I see a rough metamorphosis. But I think we can agree on one fundamental thing. The very definition of value is being rewritten before our eyes.
It is. In a world of total digital abundance, the only thing that matters is what cannot be copied.
Which leads us to the ultimate question that every listener needs to ask themselves right now.
Exactly. In a world where intelligence is free, where every digital creation can be replicated by a swarm of Einsteins in seconds, what is the one thing you own that cannot be copied?
And if you cannot answer that question, you might find yourself on the wrong side of the rotation.
Thank you for joining us for the debate.
Until next time.